Hello, everybody. Thanks for joining us. My name is Jeff Lusick. I'm the head of the retail sales team here at Horizon's ETFs. I want to welcome everyone to today's webinar on dividend stocks, and we're joined by Fiona Wilson, portfolio manager at Guardian Capital, and Guardian Capital is the sub-advisor for the Horizon's dividend-focused ETFs. So I'd like to thank you for your time. I just want to set the table that we'll try to have everything done, including questions, within an hour, so you can plan your day and allow you to get to the football games if that's what your plan is for the days. So happy Thanksgiving if there's any U.S. attendees on the happy American Thanksgiving if there's any U.S. attendees on the line. So before we get started, I'd like to go over a few items so you know how to participate in this webinar. You will have the opportunity to submit text questions to today's presenter by typing your questions into the question pane on the control panel, which is up on the right-hand side. You may send in questions at any time throughout. We'll collect these throughout the webinar and try to address them at the end of the call. Or if we're not able to get to them, we'll try to respond individually within the next 24 hours or so. So just want to make everyone aware there is a download section where under handouts where you can download this presentation we're reviewing, the Horizon's product lineup as a whole. The product sheets for two of the dividend-focused ETFs we're focusing on today, HAZ and HAL, and also a brochure on our GPS dividend investing piece. So these are available at any point on your control panel, and you can download those at any time. So please note that this call is recorded, so you're free to listen to the content at any time. It'll also be available afterwards via email or on our website following this presentation. So the reason why we focused on this today, we thought it was an opportunity to revisit dividend stock investing. Growth stocks have really had quite a run for a couple years, and then more recently starting to feel a little bit of pressure there, a little bit more of a sell-off in the growth stocks, and we want to sort of get everyone focused back on why it might be a great time to look at dividend equities again as a core part of your equity portfolio, and why these can be a great holding for you over the long run in part of the portfolio, getting some income, getting some growth. So that's why we decided to do this topic today. I think it's a very timely topic and something you should really look at for your portfolios. So where are the best global dividend stocks? So Horizon's ETF family of dividend ETFs cover the entire globe of dividend opportunities: Canadian, US, global, emerging markets, and international. Each of these ETFs is sub-advised by Guardian Capital, which is why we have Fiona Wilson here with us today. And Guardian is a recognized leader in dividend investing. They have a strategy that referred to as GPS strategy, which stands for growth of dividends, payout of cash flow, and sustainability of the payout profile. And the beauty of this is that we're focused on the total returns, which is the combined performance of the price returns and the dividend returns. So they're focused on stocks that aren't just paying the highest dividend yield. We're looking for an attractive yield that's sustainable, but also a stock that can continue to grow on a price return basis as well. We do have the 5 opportunities here. As I mentioned, HAZ is Horizon's active global dividend. HAL is the active Canadian dividend. HAU is the Horizon's active US dividend. HAJ is the Horizon's active emerging markets dividend. And HADM is the Horizon's active international developed equity markets. Horizon's active international developed markets equity ETF. It's a mouthful. So, but we're going to be focusing more on a couple of the mandates: HAL, which is our Canadian mandate, and HAZ, which is the complete global mandate with the most flexibility to go anywhere in the globe. So I'm going to pass this over to Fiona. She is a portfolio manager with Guardian Capital on the systematic strategies team. She joined in 2011, so she's been with Guardian for quite some time. Is a great resource for us and a great portfolio manager on our ETFs. So I'm going to pass it over to her. She's also an MBA and a CFA, and she's going to expand on Guardian strategy and a couple of our ETFs.
Thank you very much, Jeff, and thank you very much for joining in on this call today. So the first slide talks about our team. So it's a very well-diversified team. Srikanth Iyer leads the team. A lot of you have probably met him before. He's definitely a very vibrant presenter, so if you've seen him present, you would definitely remember him. And it's well-diversified, and the way he built the team was very different skill sets. So we have engineers, two engineers, Peter Michaels and Adam Chilio. We've hired Yvonne Jin, just almost a year now, and she's an associate portfolio engineer. We do use this proprietary model to build our mandates, and I'll speak to that later. So they are constantly working on the model, constantly doing R&D, very high-level work there. We hired Greg Zaninsky just over 2 years ago as a client-facing portfolio manager, so he's on the road a lot. This way, you can keep Sri and I more in the desk, which is great. And I'm co-manager of the mandate, and Jeff actually spoke to my bio, so we don't need to go into that. So the next page, dividend investing, page, oh, it's hard to see the page number, 7 I think we're at. Yeah. So what we've seen is, as Jeff mentioned too, we've seen a huge growth market. We've seen the FANG stocks do extremely well. We've seen an unprecedented amount of Fed intervention, and there's been so much interest in these high growth stocks. And people have been starting to think about, oh, I don't know about dividend stocks anymore. They're kind of boring. They're kind of lagging. But dividend stocks actually are very, very important. And in the long term, they have a proven record of adding to long-term investor returns. They smooth earnings. They reduce volatility and share price movement, so they're a lot lower beta. And there's another slide I'll show you after, which is quite representative of this. And what we do there is we actually pick the best of breed. So I'll speak to kind of our global mandate, HAZ, but I can also speak to any of our other regions in HAL, which is our Canadian mandate too. But in the global universe, we bought the best of breed companies that pay sustainable and growing dividend income. And right now, dividend yields provide price appreciation. And at the moment, there's still higher income compared to bonds. I mean, we've seen quite a bit of volatility in the interest rate space, but the 10 years are trading around 306, 307 right now in the U.S. So again, they've went up to 325, but they've come back. And a lot of people are also speaking about there was like 3 to 4 hikes next year. That's really been brought down in the last couple of weeks to maybe 2 or 3 hikes next year. So the interest rate sensitivity, the interest rate volatility is going to be there, but I think the height of the rate, the amount of rate hikes will decrease. So why choose Verizon's ETFs? So we have a consistent, disciplined approach based on model fundamentals incorporating 3 facets of investing: relative opportunities, intrinsic conviction, and objective non-human analysis through machine learning language. So I'll speak to some artificial intelligence, which is quite interesting. And basically, we use artificial intelligence to project dividend growth forward 1 year and probability of dividend cut. Our portfolios target companies that grow and pay sustainable dividends with modest long-term capital growth, and basically you can hold them across multiple phases of the market cycles. And that's what we're seeing now. We're seeing actually quite a different phase in the market cycle. If you go back, if I was presenting the seminar probably 3 months ago, I'd be saying, okay, well, the volatility is coming back, but it hasn't quite hit yet. But what we're seeing now is extreme volatility, and the VIX is actually averaging above 20%, which we had 11% VIX for about 2 or 3 years there, which was rather silly. And it makes for kind of everyone can shut their eyes and put their money into something and it's going to go up. But when volatility comes back, active management really, really takes hold again. And you really need to be knowing who's managing your portfolios and what stocks they're picking. And we're also different than our peer group as we continue to find yield outside traditionally defensive sectors. So if you look at, I'll get to it in a few minutes, but if you look at our sector allocation weights, we're a lot more diversified than a lot of our peers. We have a slight overweight of utilities, but we're not 15 to 20% utilities.
Not just utilities. I've seen some articles recently that everyone's going back to the utilities or consumer staples.
Exactly. But the last 3 months, we're seeing everyone defensive are working again. We haven't seen defensives work for a long time in the market, but actually cyclicals have really come off favor because of the volatility. But we actually have a nice portfolio that's built within all the GIC sectors. So we've done well when markets have gone up, and then when volatility comes back, that's kind of our sweet spot, and that's where we really perform well. So the last quarter, we've actually garnered a lot of alpha in these volatile markets. So if you go to page 9, why dividends? Why did we start our dividend mandates? We actually started them in 2007. 2011, dividend was the #1 performing factor in the market. So since then, everyone has a dividend fund. The last 2 or 3 years, dividend hasn't been the #1 performing factor, as we mentioned earlier. As Jeff mentioned, growth has been very strong. But we noticed this, if you look at this chart, 64% of your return comes from dividends. So 2007, we said, let's start building dividend mandates. And it was quite interesting because I remember, 4 or 5 years ago, 6 years ago, dividends were only for retail investors. Now you see institutions jumping on the bandwagon, everyone's into dividends. So dividends are very important because they give you a nice sustainable yield with a lower standard deviation.
Right. Yeah, more pensions are looking at it to fund their liabilities. So it's not just a retail phenomenon anymore.
It's interesting because I wonder who's wagging, the tail's wagging which there, because everyone kind of always says, institutions are in a different area, but they're not actually. So yeah, a lot of institutional funds are purchasing dividend mandates now. So what have we been seeing in the market in the last 5 or 6 years? Free capital, rampant liquidity, speculation have created some landmines in equities. A lot of the short duration, kind of higher yielding dividend paying stocks, which have more volatility and a higher probability of dividend cut, there's been a lot of interest in those. Long duration stocks, so the growth stocks, we all know the FANG stocks, they don't pay any dividends. Everyone's betting on future growth. They've really been bid up. Floating rate risk. Another thing that's been kind of interesting is with these low interest rates, a lot of companies haven't locked into their debt. They're still using floating rate risk. So now, with volatility in the interest rate space, you really have to look into that and make sure your company has locked into the debt, or they're not highly leveraged using floating rate interest. And crowded equity income funds, we've seen this, disappropriate share of active, basically everyone's crowding into certain stocks, and there are large percentages of indexes, and you can see now how volatile these stocks, and the last one is small caps. We've seen really nice moves in small caps, but now, obviously, in the last 3 or 4 months, small caps have been extremely volatile. You don't see the liquidity there, and that's kind of what our landmines that we're seeing in the equity markets, and they're becoming a lot more relevant now with the volatility kicking in. If you go to page 11, this is a great chart. So this shows the beta of the very bottom line is dividend growers and initiators. The black line is all dividend paying stocks. The green line is just kind of yield for yield stocks. The green line, not the green line, the red line. The green line is dividend cutters. So as you can see, dividend cutters have the highest volatility. You don't want to buy a stock that's going to cut their dividends. Usually, with the after a stock cuts its dividend, it usually down 10%, then it might rally back 1 or 2% the next 2 or 3 days and drops another 5 or 6%. So they're quite volatile stocks. The key to this chart is the orange line. That is the beta of growth stocks. Now remember, this is 10 years rolling beta, so it's smoothed out. But growth stock volatility has been crushed. If you look at this in the short term, that will start popping up. If you look at 1 year, that's going to start moving a lot higher because of the last quarter. But because of this, people own maybe 3 or 4 stocks in their mandate because everything's like the FANG stocks, for example. So they think if the market goes up 10%, they're going to be going up to 10% or more. Market goes down 10%, they'll be going down. But no, the beta of these stocks is screaming back up now because volatility is coming back. So this is kind of a hidden risk in the equity market that a lot of people haven't noticed because we've been in a bull market for a long time and we've had so much Fed intervention that we've basically seen the beta of growth stocks being crushed. Again, if I pull this chart up and just look at the last 3 months, that orange line is going to be coming a lot back up.
More beta in the growth stocks recently.
Exactly. So people like dividend mandates because they were lower beta, but actually when the growth stock beta is getting crushed, that kind of takes away that advantage. Now, in the last 3 or 4 months, that advantage is definitely coming back. So the next chart shows where we are positioned in the spectrum. So we're the blue. Guardian Global Dividend is the blue dot. So if you go to the far left, we've kind of pulled a whole bunch of different dividend mandates, and the red dot is kind of the average yield of dividend pretenders. So a lot of these dividend mandates out there, because they're chasing a growth market, had a lot of stocks that don't pay dividends. So their yield actually has been below the benchmark at about 2.11%. So what they do carry is growth estimation risk, market downside risk. So right now they're not outperforming the market because the market's been so volatile and they're owning the growth stocks. Higher volatility, lack of income, and as I mentioned, too, growth style risk. MSCI World comes in at about 2.35. We're at about 3.35 because we're dividend yield plus dividend growth. Dividend growth is a key factor in the way we build our portfolio. If you compare us to the MSCI World High Dividend Index, we are a lower yielder. And then there's also another bucket of dividend mandates we kind of call yield hogs. What they're more susceptible to is credit risk, interest rate risk, which we're seeing right now big time, dividend cut risk, lower growth, regulatory risk, and they have more of a value style in them. So this is how you can see we're positioned in the landscape. We're not yield for yield by any means, which in this kind of environment is a bit dangerous because more companies are cutting their dividends and because of interest rate volatility. Yeah,
volatility. Interest rate hikes more sensitive.
But we're not changing our style. We're saying we chase the market the last 2 or 3, 5 years to say we're growth. One of the number one factors for long-term manager underperformance is style drift. So any manager you buy, you don't want them to change their style to chase the market because no one knows when that style is going to change. You own your growth managers, so when you buy a dividend stock manager, you want them to be doing what they say they're doing. So the next kind of depicts this too. We're in the medium GPS, as Jeff mentioned, for growth, payout, sustainability. Medium duration stocks, half growth, dividend, half dividend growth, half dividend yield. The shorter duration stocks are really high yield with no growth, and the longer duration stocks are more of the growthier stocks with no dividend yield. So, for example, Apple, we don't buy Apple, we own Apple. We're a little slight, just benchmark weight Apple. I know it's had a tough quarter, but we still have our position in Apple. But we're not buying Apple for its next iPhone it's going to produce, for its next watch it's going to produce. We're buying it for its strong, visible cash flows, its strong cash on the balance sheet, and its dividend growth record in the past and its future dividend growth record. So we're not buying it for the growth aspect of it. We're buying it for the dividend aspect and the dividend growth aspect. And this just kind of shows how different correlation of monthly returns of the S&P 500 to changes in the 10-year bond. So basically you want to have dividend growth, even if there's a dividend for the 10-year bonds move up, you're still doing well with dividend growth. If you're just obviously buying a yield for yield sake company, then it won't do as well. So kind of focused on this before, growth, payout, and sustainability. Dividend growth, key aspect in the way we build our portfolios. Payout, we have 2 companies. One's got a higher payout, but a lot more volatile payout. One has a lower payout, but a less volatile. We would definitely choose the lower one. And what does that lead to? Sustainability. Companies have to have globally competitive revenue streams, margin efficiency, strong ROEs to consistently pay the dividends every year and consistently raise their dividends. So the bottom chart is life cycle of a company. So a lot of mandates are more in the mature growth, so they're more sensitive to the interest rates. We're in the steady growth area. So that kind of shows how we are in that aspect. So the next slide shows a different kind of, and this again, to the same thing. There's basically 3 different kind of buckets of dividend companies in the whole global universe. So any mandate you buy should access all 3 buckets. So dividend achievers are more growthier in nature, a bit more volatile, but they're consistently growing their dividends, and they usually start from a much smaller base. Dividend growers, McDonald's is a very good company. We've owned McDonald's in our portfolio as far as I can remember. We've changed the weights around at different times with different strategies going on within McDonald's, but right now we have a nice weight and overweight in McDonald's, and it's done extremely well. Every year it grows its dividend. I have another chart here that I show that. Very consistent stock.
Yeah, how many years in a row they've increased their dividend? I can't remember that.
Every single year they've increased the dividend. And they have nice buybacks too, but buybacks on a reasonable price base. And then there's the dividend payers. So they're, again, more kind of yield for yield. So we access all 3 buckets. for example, in 2011, when the VIX averaged 30% that year, a very volatile year, and that's what I kind of think we're starting to come back into. I kind of think the next couple of years it's going to be, I believe volatility is going to continue, and we believe that it's going to, even now, when you see stocks, if a company misses earnings, it can be down by 10%. The next day, it's up by 5%. So volatility is here, and I think it's here. We think it's here to stay. And that kind of a atmosphere, dividend growth is really important. So it's going to, back to my other comment, 2011, we didn't really own a lot of dividend achievers. We were more in the dividend growth, dividend payers. And that's kind of where we've migrated in the last 6 months. We've had some portfolio moves in the last 6 months, and we've actually become more defensive in nature to withstand the volatile markets.
So dividend achievers, is that some that maybe have just initiated a dividend?
It could be someone just initiated. BASF is a chemical company. It's quite volatile. We actually sold that a while ago because its volatility in earnings, so it was becoming too volatile. Its probability of dividend cut was becoming a bit volatile, and so that's kind of how we've moved a little bit out of that and more into dividend growth and dividend payers. This just shows that we deliver on what matters, and it's consistent over time. So if you just look at, basically we're above the average fund in yield because we're a dividend mandate, so that makes sense. If you look at dividend growth, we're above the 5-year dividend mark too. If you look at quality, we're quality. So our portfolio is built up of quality companies. I mean, I guess I've never really heard anyone say they had a low-quality portfolio. But if you had a low-quality portfolio in 2012 and 13, you would have done extremely well. That was the #1 performing factor in the market then. But a lot of these a lot of mandates, a lot of growthier mandates don't have as high quality. They have very high PE ratios, high debt. Leverage actually was another really performed very well in 2012 and 13. But we are a quality portfolio, so as you can see, we're above the medium there, and lower volatility, and that's what you want to see in these kind of markets. And as I said before, we believe these markets are here to stay, the volatility aspect, and we think it's going to be, for quite a while now, we're going to see more volatility, which is actually a healthier market, and it's more of a stock pickers market, and that's, as portfolio managers, we obviously like a stock pickers market. So this kind of talks about our discipline. Basically, we have a systematic approach. We look at fundamentals across global markets. We also use in-depth cash flow analysis, which, again, in 2012 and 13, didn't really matter that much because the highest leveraged companies did the best. Going forward, it hugely matters because interest rates are moving up. A lot of companies can't afford. A lot of companies actually have board money to pay dividends and buy back shares. Those are the kind of companies we want to own, and those are the companies that we screen out. And artificial intelligence, again, we're using that for future dividend growth and probability of dividend cut. So in relative, what we look for is factors that are commonly rewarded across global markets. When we began, we built our proprietary model, we realized that the same factors are rewarded within all global markets. But within sectors, we actually weight them slightly differently. We also have a dynamic, we use a multi-factor model that covers growth, efficiency, quality, credit risk, valuation, size, momentum, and sentiment factors. We also have dynamic factor weightings. For example, we correlate growth factors with 3-month price momentum. It's positively correlated, significant T-stats, right? It'll be slightly more heavily weighted at that time. So the banking crisis, you could have bought the best growth stock, but growth stocks weren't working. The only thing that was working were balance sheet factors. So at that time, our balance sheet factors were slightly more heavily weighted. So that shows our dynamic aspect. And again, we're looking at all the fundamental factors, ranking them from 1 to 10, taking the scores, and within each sector, every stock is fighting for the top position in the model. And it's a really nice way to look at the global universe. And we're looking at the rate of change of the factors. So it's the delta of the factors. So it's very easy to compare a company denominated in euros, different tax systems, compared to a company denominated in the U.S.
So a lot of quantitative data goes into your process,
Exactly.
And then fundamental, you're doing some.
Then we overlay on top, and we decide, because we get 150 buys out of this. Well, we look at the whole universe, and there's approximately around 150 buys. So within that, we build our portfolio. And right now, actually, we have 50 names in HAZ. So we've actually trimmed our names in the past probably 3 to 4 months, gotten it slightly more concentrated with volatility picking up. We want to be more consistent with the names we own. We don't want to be the market in this kind of a market. You don't want to own the market.
Right.
You want to own strong quality stocks that you're comfortable with.
Right, so sort of a concentrated portfolio of your best ideas, both quantitatively and fundamentally.
Yes, exactly.
Right, perfect.
And then for the intrinsic, as I mentioned before, we're looking for consistent cash flow. Again, as I mentioned with the Apple example, less dependency on long-term future earnings and a lower cost of borrowing for peer groups. So we actually do a duration calculation for our portfolio, which is kind of like bond duration, and our portfolio as a whole can borrow less than the market can. So that's what you want, especially in a rising interest rate environment, which we're seeing now, and a volatile interest rate environment. And then the next, a machine learning language. So this is really interesting, and I don't know any other managers that actually incorporate this into the way they build their portfolios. Everyone looks at 1 year past dividend growth, 3 year past dividend growth. We also obviously look at that, and that's a factor in the model. But we, because of our quantitative background, our engineers, we use artificial intelligence. We use a random forest algorithm that consistently ranks one of the most powerful supervised AI techniques. So it's the same kind of technique that, for example, Chicago Police Force would use to decide how many police officers will be in certain area at certain times for crime rates. We use this to give the projection of 1 year forward dividend growth. So that's what really interesting. So that's really important now. We've been in a 30-year bull market for bonds. That's changing, right? So you have to be looking forward, not backward. And from that, we can pull out the probability of the dividend cut.
It looks at both, looking at the probability of continued dividend increases, but also the probability of a dividend cut.
Exactly, which is really interesting. And I think it's, everyone's talking about artificial intelligence now. It's a lot of companies are using it for a lot of different reasons. So we're using it to look at the probability of dividend cut and future growth. And it's actually worked quite well. Obviously, we've back-tested it. And we've been back-testing this for over 5 years. We just added in our model at the beginning of this year. So it takes us a long time before we put something in our model, but we definitely do extreme amounts of back-testing. So this is an example. So this is an Anheuser-Busch that we used to own. So if you look at the forecast probability of dividend cut, and what actually the model does, it will overestimate the forecast probability of dividend cut. We're okay with that because if it overestimates it, and we actually do sell a stock and go into a different stock, and it didn't cut its dividends, we're comfortable with that. And it underestimates the future dividend growth. Again, we're comfortable with that. So that's what the model, the two kind of tails to the model, which we're very comfortable with. So if you're looking at the blue line, and kind of look, Anheuser-Busch cut its dividend October 25th. So as you can see, our probability of dividend cut moved up, I guess it was like
in advance of that.
Like 2 or 3 weeks in advance. And you can look at the stock price going down. Basically, the model kind of popped up, then came back down. There's a really quick pop up down at the beginning. That was a bit of funny down in there. But then it started coming back down. So we started to exit our position of Anheuser-Busch, and we were out of our position before it cut its dividend. So this is a really good example of actually how this works in real life. GE is another example. GE cut its dividend from about 3 or 4 months ago. We never owned GE. It didn't screen well in our model. But we went back to see, okay, what was the probability of cut? About 3 or 4 months before it cut its dividend, it had about a 10 to 15% probability of cut. Shot up to 38% about a month before, and then GE cut its dividend. So this is actually quite representative of what's happening in the market, and it's a very good risk tool when building a dividend mandate, especially in this kind of environment, especially in an environment with rising and volatile interest rates and getting near the end of a long-term bull market. So this kind of shows what we get out of this. So this is HAZ. So let's just look at the top line, which is consumer discretionary. Our portfolio is kind of light blue. The top quintile, or the top 20%, is in white. So basically, we've taken the top 20% of the universe to compare it with. So our yield in consumer discretionary is about 2.9. We could easily give you 5.22. Sure, let's just screen the top 20%. Here's your portfolio, and we can give you 5.22. But our growth almost 8%. Well, if we gave you the top 5.2 yield, you'd have negative growth, and our probability of cut is about 3% compared to about 27% in the top quintile. So if you go down to the bottom of our portfolio, we're yielding about 3.2 right now. Again, we could easily give you 4.6, but our growth is twice as much as the 4.6 would give you, and dividend growth is key in these kind of markets. And our probability of cut is 4.9 compared to 13.2. So So you really can see the risk-reward trade-off. So here's HAZ, and this is as of November 15th. So basically we've, as I mentioned before, we've kind of changed some of our positions around in the last, well, not changed our positions, but we've, in the last 3 to 4 months, we've become slightly more defensive. We've increased our utility position. We actually kind of started adding to our utilities when 10 years were about, in the U.S., I always usually speak to U.S. 10 years. When they were around 323, utilities were really getting hurt, and we thought they were overdone. So we have about an active weight of about 5%, which actually is 4.6, which is our weight of 7.8% is a pretty low weight for utilities compared to a lot of our peers. A lot of our peers are, as Jeff said, utilities, telco, staples, or REITs, and they're around 15 to 20% utilities. So our utilities are 7.8. Exxon is a name we bought probably 6 or 8 months ago. It's up 35% this year. So that's a utility. So it's done extremely well. So if you bought the utilities when they were undervalued, it was a nice time to get in. We are overweight energy by about 3 because we need to get our yield from somewhere, and we have been getting our yield from energy. We're taking down that weight slightly as we see energy become more volatile. We've added to our consumer staples weight. So what we've done actually is we've kind of taken some of our information technology weight off, which were below the benchmark by about 3%. We were close to at the benchmark. We did quite well in information technology. And for a dividend mandate, if you look at us, a lot of dividend mandates don't have any weight in information technology because it's not a high dividend yielding sector, but it's got really strong dividend growth. We actually had a good weight. It did extremely well. Saw some of the earnings becoming volatile, took that weight down, went more into staples, as I mentioned before, got a lot more defensive in the last 3 to 4 months, which has really paid off well for us. And then, as you can see, we're underweight utilities and financials. You can see some of our largest holdings, the Canadian dollar. Right now, we're holding around 5% cash. With the volatility of the markets, we're comfortable with that, and we're looking for opportunities to buy when stocks are beaten down. And you can see what we don't own. Obviously, our underweights would be Google, Alphabet, the 2 Alphabet stocks, the Facebook, the Amazon, and that's how obviously would have hurt us in the markets prior to the last 6 months, but now it's actually really coming back nicely because we don't own Facebook, Amazon, Google, Netflix, which are extremely volatile at the moment. And this just kind of shows you, so this is only until November 15th. It actually looks even a bit better to go to now because the volatility has continued. So we have had some really nice traction in the market this quarter, and that's what you want to see. We usually perform well in volatile markets. If you go back and look at our alpha from inception, it's highly correlated to volatility. We haven't had a lot of volatility in the last, 6 to 8 months ago. There wasn't a lot of volatility in the markets. But now we're seeing volatility come in, and this is when you need to be owning a mandate like this that does well in a volatile market, owns quality companies that have been beaten down, but now it's a nice time to buy. So Staples, Staples hasn't done well for a while, and that's why we started adding to Staples, and actually now they're doing quite well. So you kind of can see how we've done. Our utilities, Duke Energy, Exxon, they've done well for us. Our discretionary, McDonald's, Darden. So we've done really well in discretionary because a lot of discretionary stocks, Amazon, have got real hurt this quarter. But I think McDonald's was up like 12% this big quarter. So basically you're seeing some of these great stocks do really, really well. And and then you can see where our energy has hurt us a bit this quarter, but year to date it's done extremely well for us.
So historically, your mandates have done better in times with volatility and have protected better on the downside
of
the market.
Yeah, we're not a growth mandate, so we have a much better downside capture than we do upside capture. And the people who own us actually know that about us. We have a lot of, I've been out on the road a little bit, and when I'm seeing investors, they're actually really looking to add to this mandate now because these are the kind of markets. We've kind of been talking about volatility come back. Probably started talking about that a bit too soon.
Right. Well, we've had a bull market in equities. Growth stocks have done really well. We've had a long bull market in bonds. Now both maybe have started to turn, so investors might be looking back at the core dividend equities that can offer a nice dividend and some dividend increases.
Exactly. That's exactly what we're seeing, and it's nice to see that again, and it's nice to see a stock for whose market come back. And this just shows again our performance if you break it out, the selection. So even our allocation effect. That we do have a slightly more dividend, compared to a growth mandate, we're more yield, but not that much compared to a lot of our peers. but it's a selection, the quality companies. That's what's really, really worked out. And our yield's about 3.2. You can see our price to cash flow, our PE. So we're cheaper than the market right now. Forward-looking, we're pretty much at the market, slightly a bit more expensive. You can see our ROE is better than the market. So you can see all the characteristics that build this portfolio. When it says number of securities at 51, that is including cash, so we're actually 50 right now. And as I said before, we have about a 5% holding in cash at the moment. So this kind of just gives you the depiction. So because we've seen such volatile markets the last quarter, really wanted to show you how this portfolio behaves in these kind of markets. And that's what this is showing you. So as I've been speaking a lot about dividend growth, just kind of showing you that actually our portfolio is doing what we are saying, and the percentage of the portfolio that has increased its dividends in the last year is actually 80%. So 80% of our portfolio has increased its dividends. This is from September to September. Since then, some of these names that are actually in this mandate, we don't own anymore. As I said to you, we took some profit in some of the information technology area, and actually basically, so we're out of Broadcom now. We don't own Texas anymore. Those are some of the names that we've actually sold out.
Okay, so on this, the percentage of the portfolio that raised dividends, 80% of the holdings increased their dividends this year?
Yeah, from September 30th to September 30th.
And typically over the years, that's sort of in that range?
Yeah, at different times, because dividend growth is always important, but I would say, for example, if I had to go back to 2011, I think it would be slightly lower because there weren't as many companies growing dividends at the start, and we were more defensive in nature, and we were a bit higher yield, and bond yields were rallying, so at that point, we'd be a bit lower.
That's a great statistic. So you're getting a higher dividend yield from those companies you own, and traditionally they would do better, the returns would do better as they're increasing their dividends.
Exactly, because the companies have enough cash on their balance sheets to increase their dividends. And they're well structured, and they're not highly leveraged, not boring to pay dividends. They have the cash there. They have the cash flow coming in from their sales, and that's nice.
Any cuts in that 12 months? Did you own any stocks that?
In the last 12 months, we have not owned any stocks that cut their dividends. Anheuser-Busch is a very good example. We did own it, but we got out of it before it cut.
Great.
So that's good.
Excellent. Thank you.
And Seadrill is actually another example. A long time ago. When energy was around 80 or 90, we owned Seadrill, and I don't know if everyone remembers the drillers obviously became very volatile with the energy prices, and we were back testing the AI model at the time, and the probability of cut of Seadrill really went up a lot higher, so we actually sold it, and it cut its dividend about 3 months later. So it worked well in the energy sector too. It's worked well in all sectors, this component. And also to positive buyback yield, companies are buying. So we do look at buyback. It's not a huge weight in our mandate. Obviously, they have to have strong balance. If they're just borrowing to buy back their shares and they don't really have the earnings to cover it, and the shares are too expensive, that's not something that will screen high. So that wouldn't screen high as a positive buyback yield. So this just gives you an example of one of our companies, Nestle. Can you spot a recession? So look at 2007, 8, 9. When you saw what we saw was going on in the market, but Nestle continued to grow their dividends and continued to buy back their shares. So that's what you want to see, over 2 decades of consecutive annual dividend increases. And they've got a strong dividend growth, 5-year, 1 year forecasted about 5 or 6% right now. Actually, no, sorry, 7.2%. And this is a strong company that's done well. And even the last quarter to date, if you look at their performance, they're around 7%. They've done about 7% in the last quarter, compared to the market being quite volatile and not very strong at all, with the negative market down about 6. So these are the kind of stocks you want to own. McDonald's, as I kind of mentioned before, the same kind of scenario, raises dividend every year since 1976. It's one of just 53 dividend aristocrats in the S&P 500 index. And it's reducing. And again, I said, McDonald's had a very good quarter compared to what we saw the market doing. So these are the stocks you want to own. They're not that sexy. They're, chocolates, hamburgers, but they're strong, quality stocks.
Yeah, great examples of companies that you'd want to own through this volatility.
Yeah. So this just kind of talks about what happened the last 5 years. So if you rank the sectors for dividend yield, so the lowest yielding sector would be IT, and then you've got the performance of every year, so 2013, 14, 17, and the cumulative performance. In green obviously is good, red is good, and you can see it goes down. Your lowest ranking yield sectors had your highest performance. So as a dividend manager, it's been, these growth markets, as Jeff and I have been speaking to, have been tough markets. Your highest yielding sectors have had your worst performance. That's starting to change now. But again, it's a different market, because if you look at 2011-12 when dividend was the number one performing factor, you had still a rally in the bond, like you're still in the bull market in bonds. We're not in the bull market in bonds anymore. So we're seeing volatility in that space. I don't think the 10 years are going to blow out. And as I said before, I think the Fed is kind of slowing down its pace because we're seeing some of the economic numbers of the states come down. So they're worried a little bit about that. But I think that's what we're starting to see. So in the next slide too, it just shows the same thing kind of, but if you're sorting it for countries, exact same thing. Your lowest yielding countries have been your highest performers, and your highest yielding countries have been your lowest performers. So again, it's been difficult in the dividend space in these kind of markets. And then the next couple of slides just show that there's increased breadth of dividend growers. So dividend growers and initiators there's more and more stocks. More and more companies are paying dividends now. That's what we like to see. But you've got to be careful. You can't just buy a stock because it started paying a dividend, because it may not have the cash flow to back it up. So that's why we do obviously the in-depth analysis that we do. You don't want to just screen for dividend growth either. And you don't want to always look at past growth. That's why we look at our future growth with our artificial intelligence component. And then the next slide speaks to dividend yield by region. So you can see obviously the highest yielding regions and how they've been moving. So you can see obviously Europe is a very high yielding region. The U.S. is one of the lower yielding regions. Emerging markets has a fairly high yield actually, but not a lot of stocks pay dividends there. It depends on which stocks you're kind of going for. So, and if you speak to HAL too, I don't think I have there's not, but anyways, HAL is our Canadian dividend. A lot of people look at us for global, but actually our HAL has done extremely well compared to the Dividend Aristocrats Index, which is benchmarked, but also compared to the TSX. We've done extremely well against that. So that's, if you're looking for Canadian mandates, HAL is a very nice mandate that has lower volatility. And
it has done extremely well for us in the Canadian dividend space. Has outperformed the broad market and the dividend mandates. And I think one of the reasons it's done so well, and you can speak to it, is because you're using the same approach when you're analyzing global stocks to the ones that you're analyzing Canadian stocks, and maybe how they fare in the global marketplace, and that has identified really good opportunities.
Yeah, that's a very good point, Jeff. That's true. Yeah. So it's a well-diversified team. It's a well-diversified approach. We've been doing this for quite a long time, and we really, and actually as a team too, our partnership with Verizon, we're very accessible as portfolio managers. So if you ever would like to speak to us about any stocks, about anything you're thinking in the market, just contact someone at Verizon, and you can get myself or Sri on the line at any time, and we're very open as portfolio managers to be speaking to investors.
Excellent. Thank you for the review, Fiona. That was an excellent review of your strategy, why you should be looking at this type of strategy and these type of stocks as a whole in general over time, but especially during times of volatility, and highlighting how you can do well during those times of volatility and protect better on the downside by finding those companies that are increasing their dividends. So I'll just quickly review the reasons why you would want to own the Horizons ETF sub-advised by Guardian, and remind everyone that these are actively managed dividend strategies. They're trying to generate better risk-adjusted returns than just the broad index strategy. We feel the active management can deliver that better risk-adjusted return, so similar type returns with less volatility. They do focus on larger dividend-paying companies, which helps reduce volatility versus the broader market. I know Sri always refers to the term global gorillas in terms of dividend growers. All the stocks are selected by the same global screen, and owning those stocks that screen well against their global peers, and that applies for all the mandates. And that focus on total returns, so dividend, but also price appreciation. So they're not just trying to find the stocks that have the highest dividend yield. They're trying to find those stocks that can continue to grow their business and increase their dividends. And we'll just review how the performance is done across the mandates. We have them listed there, and the top one is is the global dividend mandate, which is coming on, which is over an 8-year track record with us now. So a long track record, an excellent since inception number, an excellent 5-year number in that space. And then if you look on the shorter end, it's done a lot better than the broader market in the short time period. So if the market is turning where more and more investors are going to look at dividend mandates as opposed to just chasing the growth, we feel this is a great mandate. The next one there I want to focus on is the HAL, Verizon's Active Canadian Dividend ETF, and that's the performance there across the board is excellent. So if anyone's looking to combine a Canadian mandate with a global mandate for your sort of dividend exposure, that's a great idea, and the performance is quite strong across the board, and also 8-year track record in that Canadian mandate with us. So we'll just put it on the disclaimer there for a second, and I just want to again thank Fiona and thank everyone for attending today's webinar. We'll get to the questions. The webinar focused on dividend stocks and how you can use this GPS strategy for your dividend portfolio. So if you do have questions after this webinar, please contact info@horizonsetfs.com or look on our website for any advisors out there to see who your sales coverage is for yourself, but an email or a call to our 1-800 line or an email to info@horizonsetfs.com, and we'll make sure we answer your questions. And once you leave today's webinar, you'll receive a survey on the presentation. We'd appreciate it if you could complete that for us so we can always continue to learn and get better and service you and get you what you need. And you'll also receive a follow-up email with the replay of today's webinar. So we're going to get to the questions. One question that's come up here, we have addressed volatility quite a bit, but one question is, do you think volatility will continue in this market, and what strategies work well in a volatile environment?
So yes, volatility, as I mentioned before, we believe it will continue and be a lot for the next 2, 3, 4 years. We're not, these kind of markets, there's been a lot of, as I mentioned before, a lot of low quality stocks have done extremely well, and a lot of PE ratios are out of whack. So that needs to come back. And there's also a lot of concentration in a few stocks that everyone owns, and everyone thinks that they kind of can only go up. Now we're starting to see that shake out. So this is where you need to have active, we believe you need to have active manager, but, and a dividend mandate like ours where you have dividend growth, not just yield for yield's sake, because you've got the volatility of interest rates, and we're a lot less volatile to interest rates than a lot of our peers. So this is the kind of mandate you want to own in these kind of markets.
Good, thank you. Next question is the sensitivity to interest rates, and how sensitive to interest rate increases is your dividend mandate? I'm assuming the question is based on some high dividend stocks can potentially sell off when interest rates are hiking as there's a substitute for those dividends. So specifically, do you look at interest rate sensitivity of your dividend equities of your stocks, and do you measure that and monitor that? We basically,
so we definitely look at the sensitivity of our fund to different, so we can shock different interest rates and go back in time and see. So we are, as I said before, a lot less sensitive. If you look at interest rates too, if dividend growth is a lot less sensitive factor than obviously yield for yield, as Jeff kind of mentioned. So, and also too, when you see yields go up, it's often at the very beginning, a lot of the yields in stocks get hurt, and then dividend growth comes back and it continues to grow. There is a chart in here that does show as a whole dividend growth, how it has outperformed when you've seen the 10 years move up. So yes, we do look at our sensitivity, and we're a lot less sensitive to the volatility of dividend rates. I mean, sorry, not of dividend rates, interest rate
increases.
And we believe there's going to be volatility. And like even look at the 10 years, they've gone from like 307 to 320 in a day or two or 3 days. So there is a lot of volatility in that space. You know, there's corporate spreads are pretty tight, high yields are still tight. There's probably going to be a lot more volatility in that space to come.
Yeah, and I think we've addressed that throughout by not just chasing the stocks with the highest yield, but looking for those dividend growers. You're less interest
Yeah.
rate sensitive than the high dividend mandates that some people might be looking
Exactly.
for. Okay.
And I mean, if you look at our sector weights too, that really helps a lot. Again, we're not in 3 sectors. We're in we're diversified in the 11 GIC sectors, and we have good weights. And that's where it takes away a lot of the interest rate sensitivity.
And then a simple one, can I get a copy of this presentation? Yes, you can download it in the handout section of this presentation, but we'll also be sending out a replay of the webinar. Okay, and then the next question, as an option expert, do you use options in any of these mandates, Fiona?
So we actually do not, because they're pure equity mandates, and we don't, in the perspectives, we don't have part of it as an option overlay. I mean, we could, of course, use them in any mandate that we have that we're legally allowed to, but these are just pure equity mandates.
Okay, good.
But we look at the VIX a lot. So, I mean, that being said, I mean, we're always looking, at the VIX and looking at seeing how volatile what's happening with the VIX, but no, these are not overlaid with options.
Okay, and to that question, Horizons, we do have covered call ETFs within our lineup, and the product guide is available for download, and that's offering some enhanced yield via covered calls. So if you have a further question on that, we'd be happy to help you. So it looks like we're running out of time there. If I didn't get to every single question, we'll make sure we follow up very soon. But again, I want to thank Fiona and everyone's attendance. Hopefully you found this useful. We're giving you some ideas for some of your investments going through this volatile period. Always a great mandate over time as a core holding, as a dividend equity mandate, but especially now where historically Guardian has done quite well during volatile times and added value and protected a little bit better on any potential downside. So thanks to Fiona, thanks for everyone's attendance. On behalf of Verizon's ETF and our presenters, thanks for joining us today, and have a great rest of your day.
Okay, thank you very much for joining us today. Take care.
Thank you.